So the next section of this presentation is actually on growth strategy, or in particular, M&A growth strategy. And for managers and company owners in the pursuit of growth, there's typically only 3 options available to them, and determination of which to choose is often dependent on the availability of resources. And so organic growth, as we know, a build strategy, is often limited to that extent. And so you'll see when a company grows, so too do they need to invest in staff to grow the staff base, or other assets to facilitate that higher level of operations. So borrow, this is either via a contract, supplier agreements, or subcontractor agreements, or even through a joint venture arrangement where you need to bring in some combination of resources to deliver the value to the customer. And then clearly a buy strategy is sort of the topic of this part of the presentation, which is an M&A strategy, where your goal is to acquire the resources of another entity in entirety. And the key point here to make is, in terms of resource gap, is the feasibility of the integration. And often when you see M&A transactions that fail or that don't deliver the value expected at the front end, is because of a difficulty in integrating the business post-transaction. And so what are the drivers of an M&A growth strategy? I said that I'd come back to you on buyer synergy, and this is where I'd like to give you a bit more of an understanding about how that works. So the theory behind buyer synergy is a single business is worth more to one buyer than the rest of the market, and by nature, in practice, they should be able to pay more than other people because they can extract greater value from that business. A low cost of debt. You'll see up until COVID, in any event, a lot of the private equity funds have probably done quite well over the last decade, just because if they pursued a leveraged M&A strategy, the cost of debt has declined, meaning the serviceability of the acquisitions they're making has become more easy to achieve, but also asset prices have increased over that same period. So they've delivered quite strong returns as interest rates have steadily fallen, and now, as we know, we're sort of potentially heading into negative territory. And a fragmented market, this is the simple idea here is that you've got multiple businesses in the same industry, but none of them are very big. So let's call them, they're all single state businesses, and few larger national businesses. The graph here that I'd like to take you through is actually an example of how all of this comes together. And if you think about the numbers at the bottom of that page, 1, 2, 3, and 4, as individual businesses, each earning $1 million in EBITDA. Now, we know as advisors, hypothetically for this industry, we know that a business earning $1 million in this industry is typically going to achieve, in a competitive sale process, a sale multiple, equivalent to say 5 times or $5 million. And so if you were to run a competitive sale process, you would expect multiple offers in and around that $5 million mark, except for the buyer with additional synergy in addition to any of the other buyers, is that they might look at that same businesses or this same group of businesses and see, well, actually, once they combine the target acquisition with their existing resources, they can knock out, say 10 to 30% of the cost base by removing, doubled up expense items, think accounting, finance, administration, and also generate a higher level of revenue with the same resources by being able to cross fertilize the contracts of the target company with the acquirer's greater resource platform. And so for this business at 5 times, the companies, these targets are actually worth $6 million. And so I'm not suggesting that this buyer would pay $6 million, but certainly if there's a group of buyers and they're all at the same level, if anyone's got the ability to increase their offer within reason above the others, it's the group that's got the synergy. And so carrying on from that, if you imagine that each of these acquisitions are made by a buyer with a roll-up strategy in a fragmented market, and they're buying companies 1, 2, and 3, and 4, which are all single state operators, all selling for, let's call it 5 times earnings or $5 million. And then on day one or after some sort of integration period, you know, at least 3 of those companies, they can extract $1.2 million in earnings. So at the time of sale, once the roll up is complete, they're now got a business that's got combined earnings of $4.6 million. It's a national business, let's say, and as we know from the discussion previously, you know, larger national businesses that have higher margins and larger level of earnings actually trade for higher multiples. And so on sale of the combined entity, you know, the acquirer might be able to expect a 7 times multiple rather than 5. And so you can see that the sort of arbitrage that you get by pursuing a strategy like this, particularly if you've used a leverage strategy whereby, you know, let's say you're funding each acquisition with 50% debt, meaning when you do realize the value that you've created upon exit, the return on equity is going to be, you know, far superior than if you just used pure equity to fund the acquisitions. So hopefully that gives you a bit of an understanding about some of the drivers behind an M&A strategy.